Major funding for these programs is made possible by grants from Capital One Bank, New York Community Bank, Eastern Consolidated, M&T Bank, Customers Bank, Meridian Capital Group, Terra CRG, the Witkoff Group, Perfect Building Maintenance, Chase Commercial Term Lending, Chase Commercial Mortgage Lending, Genova Burns. Additional support is made possible by AKA Hotels, Corman Communities, AmTrust Title, Ariel Property Advisors, AVR Realty Company, Bank of America Merrill Lynch, Bank Leumi USA, Briarwood Organization, CBRE, Citizens Bank, Connect One Bank, Colliers International NYC, Collins Building Services, CPEX Real Estate Services, Dime Savings Bank of Williamsburg, Douglaston Development, Levine Builders, Fisher Brothers, Flushing Bank, Friedman, LLP, Hendler Real Estate Organization, Hersha Hospitality, HAP, Investment Developers, Hodges Ward Elliott, Inc., Investors Bank, iFunding, James D. Kuhn Real Estate Center at Syracuse University, Kilroy Architectural Windows, Madison Realty Capital, Matone Group, Mercantile Commerce Bank, New Banks, Newmark Grubb Knight Frank, Optimum Window Manufacturing Corp., People's United Bank, Paulsonelli, Rosewood Realty Services, SJP Properties, Sterling National Bank, Stonehenge Partners, TD Bank, The Continuum Company, the Knackle Group at Cushman and Wakefield, the Meringoff Family Foundation, the Moynihan Group, and these friends.
So in today's environment, many people in the real estate business are not borrowing from banks because banks have changed rules. There's the Dodd-Frank initiative. There are other requirements. So there's been a role for what we would call the non-bank lenders. So today I've assembled a group of business leaders who are going to provide their insight on what's happening with the non-bank lenders providing real estate financing. My guests today include Josh Ziegan, who is the co-founder and managing member of Madison Realty Capital, Bob Foley, who is the CFO and chief head of risk for TPG, Jason Hart, who is a managing director for the U.S. real estate group at the Carlyle Group, and last but not least, the co-founder of the Tall Pines Capital, Brad Settlement. So you've been in the non-bank lending business for how many years now?
12 years.
And you?
12 or 13 years.
You're a borrower, okay?
Combination of debt and equity, but more debt these days in the last 2 years.
You know, Dodd-Frank was initiated in 2008, 2009. Now some of the rules are happening over there where they're saying banks have to have more capital requirements. One, banks cannot look at a situation on the valuation of an asset. So how busy and who's coming to you with regard to non-bank financing?
So I think, the last, I would say, 6-7 years, the box has just narrowed from a traditional bank standpoint. So what we see today is that banks will sort of reject things at a high loan to cost. The borrower would need to have a lot more equity in the deal than previously. Time-sensitive situations, anything that has a story or some special situation really falls on our desk. And the traditional banks are having a tough time banking that kind of deal, and that has opened wide over the last 5-6 years.
But in essence, aren't the traditional banks partners with you or participants in you, because you're going to that bank to provide a loan on what we call the A piece of the deal? So the banks are still lending, but they are their requirements of how much they can lend has been diminished based on the circumstances over there.
I think that's right. And I think in that regard, the regulations have had their intended effect. They've had unintended consequences as well. But I think banks are generally taking less exposure to the underlying collateral. And when they lend to non-bank lenders like TPG Real Estate Finance Trust, they're doing that because we don't borrow at very high advance rates to begin with.
But how high, as one would say in the capital stack, how high will you go in the capital stack on a loan? Because at one time, banks would go 70 or as much as 80% of the total loan on the capital. How high will the TPG go?
I would say, generally speaking, our first mortgages top out between 70 and 75% of cost. I think banks top out between 50 and 60 something, depending upon the underlying collateral risk. And when we borrow from banks and other capital providers, their look-through LTV is typically in the neighborhood of 50% of the underlying collateral value.
Brad?
We've gone as high as the low 80s, but value, it depends. Are you talking cost or are you talking value?
Should we be looking at cost or should we be looking at value? And who is making the determination of what value is? I've always had this circumstance, even with an appraiser, even with a rating agency. How do you determine what value really is? You're a borrower.
Yeah, it's a difficult question to answer. Being on the borrowing side, we typically think value is probably higher than what our lender is willing to say and what the appraiser is willing to say.
But what is value in today's world? I mean, how do we determine what the true value is?
There's some markets that are more liquid than others, and a New York City market has a lot of trades and a lot of liquidity to support pricing. Someone like ourselves, we have an ownership and development arm of the company as well as a lending part. So we know what we're bidding on assets every day, and it gives us some comfort to understand the value part of the equation, I think, better.
But one thing that's happening today, if you look at the statistics, we're 7 months into the year and land values have decreased. Mm-hmm. Why have land value decreased? Because there haven't been that many sales. That's one, and also because of legislation with regard to tax abatements of the 421A over there.
And I would also say it's a function of where construction costs are. Construction costs are near a peak,
and
so
where
it costs more to build.
Financing costs and absorption rates for the completed product.
So whether you look at
all dials into the residual land value.
Exactly. So if you look at multifamily, there's 40,000 multifamily units coming to market. So people are concerned about that from a supply perspective. Then if for sale, i.e. condo, there's obviously a lot of supply in the market, and people are concerned about that. So that affects your in value as well in terms of where that land is going to be traded.
If you look at the last 4 or 5 years of land sales, almost every parcel in and around New York was priced for condo. And so as the market for condo has pulled back, obviously alternative uses have to be considered, and therefore pricing has come down. There aren't many trades, land trades in New York City in the last 6 months.
One of the reasons there aren't many trades is because unless you have to sell right now, you're not necessarily selling. And the difference between this cycle and last cycle was it was much more highly levered in terms of land. Going back into 2007, today there was more equity or preferred equity or other parts of the capital stack that came in to fill the void where banks didn't fund. So that whether that actually liquidates or trades is sort of a subject to that leverage, I think. So
when you're looking at a transaction and somebody says to you, I want to borrow money on the land that I may have purchased or that I've owned, my family has owned for 25 years. Banks today, because of the Dodd-Frank rules, cannot look at the increased perceived value from the old cost. Alternative lenders can. But when you're looking at the circumstance, and then we're taking into consideration what Jason brought up with the 40,000 units coming on board, and the definite fact that the Uber condominiums are having some difficulty, and then you also take into consideration the hotel world today, where we have another 40,000 rooms being in various stages, and there is no question that Airbnb is having an effect on the world.
For every loan that we make, it's all about basis, whether it's land, whether it's a occupied building, a conversion. It's really what is our last dollar. We take a slightly unique approach, and probably similar to Josh, in that we have the capability, should our borrower go sideways, to take over a project and finish. My partner has been an operator developer for the last 22 years. Josh and his partner have been developers and operators for many years, as opposed to a pure financial lender. And frankly, senior lenders like guys like us, Josh and I, in the capital structure for a couple of reasons. One is, should our borrower slip on a banana peel, we can step in and finish it and fix it. And we're also another source of capital. And so they welcome our participation in the capital structure.
And I would say, being on the other side of that coin, being the borrower, you know that when you're, especially in development, there are going to be issues. There always are. That's the nature of development. And you guys, knowing development, you know that as well. So when that thing inevitably does occur, we can pick up the phone and call you and say, hey, XYZ just happened. You say, yep, we know that. We've seen that before. Don't worry about it. We can deal with it by this way or that way. And there's just a lot more flexibility. Whereas the bank will just say, sorry, we don't get it. You're in default. And
the last thing the bank wants to do is own real estate.
Right.
And have to step in and fix.
Right.
We're not interested in fixing either, but if we have to, we will.
Right, which is the same way that Josh over there. Right. But let's look at you. You know, you're a worldwide private equity fund. And people would say, oh, you have unlimited resources to the banking community. Why have you, and what are the advantages have you seen to borrow from people like a Josh or a Brad or a TPG as opposed to a bank?
Yeah, and listen, we still borrow a lot from the banks, and that will continue. But I would say specifically it's speed. So the non-bank lenders can move extremely quickly, and especially in a place like New York, you have to move quickly. And so that's one advantage. Number two, I would say just and kind of going to my earlier point, the ease of which they're allowed to move. And it's not because the banks don't want to move, it's just with all the regulations and restrictions now in place, they just can't. So when you have something that may be a short fuse and you have to close in 15, 20 days, and we prefer not to close all equity, we can, but we don't want to. We can call up one of these non-bank lenders and they can move in that sort of time frame. And there's been examples when we have borrowed from the non-bank lenders where there may be 3 or 4 things that are still open and it's the day before closing. We pick up the phone, say, hey, we have these things we still have to deal with. Can we make these all post-closing items? No problem. Don't worry about it. We'll give you a week. We'll give you 2 weeks to deal with it. Whereas a bank, they just quite frankly don't have that flexibility to be able to do that.
The flexibility of an alternative lender goes a long way.
Now, with regard to that, Bob, how fast can you close on a transaction?
Yeah, I think the quickest we've done is 20-some to 30 days. Our typical framework is more like 30 to 40 days. Again, in our business, construed broadly, speed is probably the most important consideration. Certainty, especially in the context of an acquisition. And to Brad's point, flexibility, I think both before closing and then during the life of the loan. Typically none of the loans that non-bank lenders make work like a Swiss watch. Some do, most don't. They have mid-course corrections along the way, and borrowers and lenders alike are accustomed to dealing with that in a way that many banks are either unwilling or regulatorily unable to do.
Josh?
Our average is probably around 3 weeks. We did do a deal last week in 5 days. It came in, and we had underwrote the purchase of an office building on 35th Street on the equity side. The borrower put up another property that was free and clear in Soho, and it was a $50 million loan. But our familiarity with the purchase gave us that comfort, and so we have that flexibility.
What asset classes do you like to finance today, and what asset classes are you maybe a little cautious? Or, you'll lend, but you might want a higher rate, or you might have other requirements?
I would say, land and hotel is something that we've, there is a price, but a lot of times we're going to pull back, and that's the area I'd say that's the least interesting. We do construction loans. There was, earlier this year, condo construction loan and rental construction loans became difficult to obtain as well. So we've seen some good rental opportunities. We just financed something on 14th Street, which was a ground-up rental deal that was vetted under 421A. So we still do construction.
We're somewhat agnostic. Again, it goes to basis. And frankly, when other lenders shy away from a certain asset class, oftentimes that is the opportunity. And we don't have to take extraordinary risk because no one else is around.
We're a national lender, and so the honest answer to your question is it depends. It depends on the local market dynamics. Lodging is clearly late in the cycle, and through payoffs we've reduced considerably our exposure to the lodging sector. But by and large, it's a function of where we see the equity value, how we feel about our last dollar of exposure, and the quality of the market and the sponsor.
In a similar manner, Jason's national on acquisitions. I mean, there is a perception or maybe actuality with regard to the Florida market, the market with regard to the condo market in Florida, as well as the hospitality market in general around the country. How do you see in different markets in the country, where is your favorite spot and where is your least favorite spot? I mean, in certain times, if it was 2008, nobody wanted to go to Vegas because it was the worst place in the world, okay? Josh?
Probably 80% of our business is New York centric. We've done some stuff in South Florida. In terms of South Florida, we're seeing obviously a pullback like in New York in the condo market. So this type of stuff we are looking at are either inventory loans or things that are like close to completion where there's more visibility in the market. But I wouldn't do like a ground up deal now because we don't have to. We're seeing the stuff that's good quality product that's at completion.
We have a similar view about South Florida. We tend to do larger loans, $50 million and up. That tends to drive us toward the larger metro areas and the coastal markets in particular.
So someone shouldn't come to you if it's a $10 million loan?
Probably not, no.
And you?
Typically 30 to 100, but we do still do some stuff on the smaller end too.
Our sweet spot is 5 to 15, so yes.
And how often have you gone to the ranks of the non-bank lenders in the last year or two?
In the last year, twice on 2 different deals.
And what type of deals?
In both instances, one was a retail deal that was basically a transitional asset, which makes sense. So where the tenant was vacating, and so we're re-tenanting the space, repositioning it. So no cash flow. And the other instance was an office building we bought in Midtown, where we're actually taking that asset and converting it to office condo. So again, transitional in nature, which makes it tough for the traditional banks to finance at a competitive rate.
With regard to the banks, how are they looking at dealing with you as a non-bank lender? I mean, at one time, I'd say 3 to 5 years ago, the financial institutions were a little cautious about dealing with certain non-bank lenders. But today it looks to me that more and more banks on all scales, okay, from the couple of $billion bank to the multi-billion-dollar bank, they're looking at a more favorable review at the non-bank lender. And the question is a twofold. That's the bank question, and how many are doing a deal by deal or based on a line?
I think, good question. I think that, look, that the banks are in a tough earnings position right now, and they're looking to deploy assets. It's a little challenging in commercial real estate given the regulatory environment. So I think they're looking for experienced, well-sponsored counterparties, and they're looking for multiple opportunities to transact. So in the case of TRT and others like us, I think there are opportunities to lend on a repo basis. There are opportunities to provide A-note financing, which you mentioned earlier, sometimes note-on-note financing. Sometimes they'll co-invest in transactions that we lead or vice versa. My sense is most of the banks, independent of size, are very focused today on trying to establish a relationship where they can make money in a number of different ways rather than just a single channel.
Josh?
Similar comments. We sort of help banks scale because we're providing a finished package a lot of times to the bank. And in many ways, we talked about the regulatory environment. With the borrower's equity and our equity behind them, it sort of gets that additional comfort layer that I think that helps the regulators along.
We often get calls from senior lenders. They can't get there on the last 10% of the loan. It's not a loan to cost that they're comfortable with. They like our presence, another source of capital. And again, if things go sideways, there's a operator developer as opposed to a pure financial player.
What's the cost differential of dealing on a non-bank lender to a bank lender in your circumstances?
Yeah, I would say it really, I think, depends on, it's deal by deal in terms of the risk level of the deal. But speaking in generalities, I would say this typical spread we see is probably 150 to 250 basis points, if I had to bookend it.
And what do you see?
I think it depends very much on the risk profile of the underlying asset. I think apples to apples, we compete against some of the larger banks. And if that's true, then our terms and pricing are probably pretty close.
You can lend at LIBOR plus 400 in certain circumstances.
Sure, I think for most people active in our space, it starts at LIBOR plus 400 and it goes up from there depending upon risk.
Which in reality, when a bank is lending on a construction loan or something at maybe 275 or 300, it's not a big high differential in the cost of the project.
No, but I think there are other structural features. The amount of recourse is typically at the top of the list. But I think there tend to be more differences in our experience than similarities between down the fairway bank deals versus down the fairway non-bank financial lender transactions.
Yeah, the spread component really isn't the factor that's moving the needle.
No,
the deal is going to be a good deal or bad deal regardless of that extra spread.
I think it's a question of the leverage.
Right, it's the proceeds that
It's
you're
the
talking
last
about,
10 to 20%
Right.
that gets expensive.
Right.
which would be
Yeah.
funded with equity. So debt at the numbers we're talking about
That's-
are cheaper than equity.
Another borrower who I've known who has pretty good sources of equity around the world, I said to him, why do you borrow more often from a non-bank lender at a higher rate than 400 over LIBOR? And the comment was made, it's less expensive than me giving away ownership in a deal.
Absolutely.
So even if I'm paying, let's say, a 10% rate, it's cheaper than me having a partner over there who's going to have, a 25% equity in my deal or my transaction.
One other thing to note is not all non-bank lenders are the same, because in many ways, if you're in a construction project and it takes you another 6 months because you can't get draws on a project, that cost over an extra 6 months is substantial. So, who your counterparty is very important. Someone that understands the project, and customizing the financing to the borrower's needs is a key feature.
You're the borrower. How do you determine which non-bank lender you went to? Is it advertising? Is it the banking community? Is it the other people in your business?
I would say it's just like when you're determining what bank to go to, and so much of all of our business is relationships. So it's, as you mentioned earlier, the counterparty risk. There are probably certain groups out there that we're probably not going to call, and others that are towards the top of the list who we feel comfortable with and have a relationship with over many, many years. That they'll be towards the top, and so we'll give them probably the first couple calls.
I recently did 2 shows on healthcare, and I had all of the large healthcare systems of New York City, who also have umbrellas now in New Jersey, Pennsylvania, and other places. And I said to them, 25 years ago, you wouldn't have a healthcare institution spending all the money having signs on buses, on blimps, and on stadiums and other things. How important is advertising and public relations to the business of your business, and your business today? Everybody knows the internet, but how important to get the message across because there's competitors. It's the same way that they're competitors in banks. How do you get that information across? Is it an advertisement? Is it press releases? I mean, needless to say, it's the customers. People talk in the small community. But besides that, how do people learn about this?
Well, I think we certainly avail ourselves of all of those channels, but fundamentally, TPG is a large global firm. We have more than 70 billion under management, and it's a well-known name. That helps. But fundamentally, market presence, being active in a market where market participants know you and they know what you are capable of doing, coupled with relationships. Those are the two channels that we focus on most aggressively.
Josh?
No, marketing is a key piece because you want to be remembered for a certain type of transaction or a certain location, and quality of deal flow comes down to how many deals you see, so you can be selective and choosy.
We're too small to have a big marketing presence, but I will say that one of the things, the best free marketing we can get is performance, and brokers will come back to us again and again and again because we perform for them.
You bring up an interesting point. How much of your business, and of the three of you, how much of your business comes from intermediaries or brokers?
Historically, and the history of our company is fairly short, but well more than half is done directly with borrowers. And we do a significant amount of repeat business.
Josh?
Probably 50-60% brokers.
From intermediaries, brokers.
Similar.
I would say on the borrowing side, we probably hire brokers about that same ratio, which makes sense.
That makes sense, yeah.
50 to 60% of the time.
And quickly on the equity side, how many deals come to you from intermediaries or brokers?
In general, I would say just because we are a high return level buyer, by that very nature, we tend to source most of our deals off market in one way or another. But with that said, I mean, we probably maybe a third come through third-party brokerage firms.
So in essence, I'd say that today, more often than not, you're going to see the preponderance and increase in the number of non-bank lenders in the market, growing in the market because of the changes of Dodd-Frank and because of the bank regulations. And it's definitely a market that's going to be there, and people are going to take advantage of this opportunity to borrow from that. I'd like to thank Josh, Bob, Jason, and Brad, and I'll see you next week.